Hey guys, welcome back to the channel. I've got a bit of a spicy one for you guys today. I want to compare two of YouTube's biggest value investors, Joseph Carlson and Everything Money. Both of these channels have absolutely huge followings, and educationally, they are a cut above many other degenerate gamble tier investors on YouTube like Financial Education's Jeremy.
I am down not 1 million, not 2 million, but $3 million.
Despite having approaches that follow the value rather than the hype when it comes to investing, both of these channels have attracted a lot of criticism from all corners.
So let's go ahead and react to this freaking doofus, right? Oh, I got spiky hair like I'm in a boy band.
So Paul Gabriel, the trust fund baby, the guy whose father basically built the entire legacy, made a bunch of money and just gave it to him.
I only consider one of them to be a true value investor, and that is Joseph Carlson. So today I want to go through both of their approaches to value investing and some of the recent controversies surrounding both channels.
Will I close my shorts of Nvidia beats? No. I'm going down with this fucking ship. I do not recommend that for anybody.
And explain why I think Joseph Carlson is by far superior to Everything Money when it comes to value investing. The late Charlie Munger described value investing as buying wonderful companies at fair prices and holding them for the long term. Now, both Everything Money and Joseph Carlson try to abide by this approach, but they have very different methods for identifying wonderful companies and what the fair prices are to pay for them.
Guys, I own Alibaba stock. There's a potential 662% return in the next 10 years.
In general, you can classify a company in terms of two different factors: its story and its financials. Its story being its moat or its position in the market, its industry, and the growth factors that it has ahead of it without losing market share to its competitors. Whereas its financials are general statistics like its profitability, how efficient it is at returning capital to investors, and so on. Now, Joseph Carlson spends a huge amount of time and effort researching both of these attributes of a company and then determining whether it is a buy based on its valuation at that point in time. But he is willing to pay a big premium for a high quality company.
Going back to the sort of debate with value investment, which you didn't raise, but no amount of cheapness will make a bad company a good one.
So he sticks to good companies no matter what the valuation is of bad companies.
Take, for example, the case of Chipotle. Joseph Carlson did a huge amount of research into the secular factors and growth story behind Chipotle and bought into the stock last year when many considered it to be extremely expensive. The price to earnings ratio was above 40 after all. So since then, how has the stock done? Well, the stock has gone up 50%. It turns out a high quality stock can just keep getting more and more expensive because it's a high quality stock. The price to earnings ratio is now nearly 60, which is pretty insane in all fairness. In contrast, in my opinion, Everything Money spend a minimal amount of time actually researching the story and business fundamentals of companies that they buy into. Take, for example, Disney, a stock that Everything Money did a video on around a year ago before they bought in. They discussed in the story why Disney should just return to pre-COVID levels of profitability because COVID was a blip and it should just happen automatically.
And look at this margin, profit margin of 4.7%. That's a low profit margin, especially considering one thing. Let's go look at it before COVID. That's what, 15% profit margin?
Yeah.
So my thesis on Disney is, if you believe that the profit margin is going to go back to normal levels,
Why are you not buying?
is this a buy?
Yeah.
Without discussing the fact that Disney has become a completely different business after COVID because it's now a streaming company with Disney Plus rather than being a linear TV company that it was before. As part of this process, they then go on to estimate what the fair value of a company's stock is by extrapolating certain financial statistics over the next 10 years or so and estimating what the company's fair value share price is in the current day. In order to do this, they use low, medium, and high estimates for things like revenue growth, free cash flow growth, and profitability. As part of this, though, they are extremely pessimistic with their estimates and also have a margin of safety, which means it's very rare for any company to actually go below what they think their fair value for the share price is. In fact, most of the stocks that actually breach this fair value threshold by which Everything Money pool will buy a stock end up being terrible quality companies that have been sold off by the market for a reason. Their stories are terrible, even though their financial metrics are pretty great. For example, some of the companies that fall into this category of value trap are 3M, a company that was being sued by the US government and sold off as a result.
All right, guys, 3M stock. I'm going to tell you something. I've started a position in 3M stock.
Or Alibaba, a company which has numerous woes, including increased competition. And also Intel, a company which has fallen way behind on its chip making technology compared to competitors. But when you look at the financial metrics, it's pretty good or pretty attractive. With such a lack of high quality companies being highlighted by Everything Money's process, you would end up buying terrible quality companies were you to follow that process, or just holding cash for long periods of time, which is a terrible strategy in the long run in order to prepare for a bargain that may never come. But with this process, surely there are some high quality companies that fall below their supposed fair value and Paul would buy in. And yes, you would be correct. When Meta's stock price plunged a few years ago, it breached that fair value threshold for Paul and he started buying the stock at around $230 per share.
Guys, I'm going to brag for a second. I started dollar cost averaging in Meta around $230, I think it was, all the way down. I actually bought it at the low of $88 a share on November 4th, 2022.
But when Meta's stock price shot up and rebounded, he sold out at $195 per share.
And guess what your fearless leader did? Stupidly sold at $195, thinking that the surge was too fast.
The stock price is now $480 at the time of filming, which means it's over double had he just held onto the stock. Remember, the golden rule of value investing is to buy wonderful businesses at fair prices and then just hold the stock. That's all you have to do. But because Paul has such a focus on the financial fair value of a company, he thought that it was overvalued and sold out. That is a very bad approach in my opinion. In contrast, Joseph Carlson is a lot more comfortable just holding a stock that he bought at a cheaper valuation but is now sitting at overvalued status.
I sell when I've made a mistake on my original analysis. I don't believe any mistakes were made during my original analysis of Costco.
It's actually a lot better to just hold an overvalued stock rather than selling it, because you never know when that stock will be cheap again. It could be years away, and in that amount of time, you've missed out on the compounding that a high quality stock usually has in the long run.
I'm not going to sell Costco, an incredibly high quality company, to buy some random, inferior, lower quality company trading at a perceived discount.
Two examples of these would be Joseph Carlson's holds on Costco and Chipotle stock. Whilst he bought the stocks whilst they were much lower in price and valuation, they've since shot up due to their high growth rates and qualities as high quality companies. Ironically, Everything Money recently did a video of 5 stocks to buy if you hate your money, and those 2 stocks landed on that list.
Costco wholesale. And guys, 260 on the low side, 430 on the high, 330 in the middle. That's without any margin of safety. I have my watch list at 290. Now you might be thinking, Paul, it'll never see 290.
Ironically though, even though today these stocks probably are overvalued, their process never would have identified Chipotle and Costco as buys a couple years ago, as it would have stated they're too overpriced at that point in time, and you would just end up never buying high quality companies if you followed their advice.
I've been saying for 5 years now stocks are overpriced, and I've been right for 5 years. But the results have said I'm wrong.
Because Everything Money slavishly adheres to the concept of a fair value of a stock, it leads to them making huge financial mistakes which undermine their credibility as value investors almost entirely, in my opinion. For example, last year at the height of the boom in AI chips, Everything Money Paul sold naked call options on Nvidia. That means he basically bet on the stock going down whilst it was in one of its biggest boom phases ever. Because Paul did a short, his losses had the potential to be unlimited and completely wipe out his entire net worth. That's an extremely rookie error to make.
Will I close my shorts of Nvidia beats? No. I'm going down with this fucking ship.
When you bet on a stock going down, the stock might go up and you'll lose money, but there's no upper bound or limit for how much a stock can go up by. It could double, triple, or even quadruple. Whereas if you're betting the other way on the stock going up, you only have the potential to lose the amount of money that you put in because it's limited by the amount it can go down by 100%. And Paul was shorting one of America's greatest tech companies in one of the largest ever AI-driven tech bubbles. So a pretty bad decision. As Nvidia's stock price continued to double, triple, and quadruple, Paul eventually ended up selling out of his short and canceling it because of tensions with his family where he had lost millions of dollars.
It has caused some strife within our family.
This type of approach is not value investing at all, and in my opinion is closer to gambling than anything else. If you watch Joseph Carlson, all he does is buy and hold stocks. He doesn't play with leverage and he doesn't short anything like Everything Money does. The amount of money that Everything Money lost on this short of Nvidia means that their performance over the long run cannot be beating the S&P 500, as they would have to make absolutely insane profits on their other trades in order to make up that difference. So why would you ever follow the Everything Money approach when you can just buy SPY and the S&P 500? That brings me on to my final point about total performance.
1, I will beat the S&P 500 over the next 10 years. 2, you will not beat the S&P 500 over the next 10 years.
Everything Money is extremely opaque about which investments they hold in their portfolio at any given moment in time, as well as the returns of that portfolio over any given period in time. Meanwhile, if you go on Joseph Carlson's channel, he will show his total performance and composition of his portfolio in every single video.
And every single company in my portfolio, the Story Fund, has officially reported their earnings.
He's also extremely open about which stocks he buys when he's made a mistake, and he doesn't try to hide anything. Meanwhile, if you compare his performance to the S&P 500, he shows that and displays it openly.
And I've been tracking the progress of this competition of my portfolio against the S&P 500 with this chart on an ongoing basis since the very beginning.
From what I've seen, he's also beaten the S&P 500 over the last few years, or at least matched it. So in my opinion, Joseph Carlson is a true value investor in the same vein as Warren Buffett or Charlie Munger, whereas in my opinion, Everything Money are just posers trying to be value investors without actually providing the kind of returns that you would if you were really value investing. So let me know what you guys think about both of these channels in the comments below. If you want to see a video about criticism that Joseph Carlson receives, then please watch this video here. And please leave me a like and subscribe if you've made it this far, and I'll see you guys next time.